Hey, what's up, all of you beautiful subscribers? Welcome back to the Chapple Show, where we talk about business and stock market news. Now, we're going to talk about a bunch of things today, like a tech IPO, Walmart, Amazon, a bunch of stuff today. But what I want to lead off with is actually this article here, this story here. This is actually from NBC News, and what the title says, now this is one of those stories where the title is completely different than the actual article. But the title is pretty much, as Black Monday turns 30, is an even worse stock market crash on its way. Is a worse crash coming? So for those of you that don't know, the worst single day of trading in history occurred on October 19th, 1987. Now today is October 19th, 2017. So on that day, 30 years ago, the stock market dropped, or the Dow Jones at least dropped 22%. In one day. The entire index dropped 22%. The entire market dropped 22% in one day. Now, that is the worst by a fair bit. That's even worse than in September 29th, 2008. Now, the crash of the economy in 2008 was much worse than it was in 1987. I mean, it's not even close. We'll get to that in a second here. But the first thing I want to talk about is a worse stock market crash coming? And here's what I want to look at here. Look at these macro trends here, as I always like to do. I won't stay on this too much because I do talk about it a lot. But let's take a look at the 1987 crash, which your parents will say was the worst crash in their lifetimes. Let's go look to this chart here. For those that are listening to you in podcast form, going back to the 80s, 1987, this little blip right here, that was the 1987 stock market crash. Now, I know the economy was smaller. I know the Dow Jones was smaller. I get it. It was still a really bad time. But it's essentially a blip on the radar that recovered fairly quickly. Okay, that's what 1987 was. It was a blip that happened in one day, and everything recovered eventually over the next year or so. Now, let's go to the next one. 2000, the tech bubble. Boom, tech bubble bursted. And a lot of the Dow Jones and S&P 500 didn't recover for about 7 years. So that was pretty bad. Now, the biggest drop-off occurred in 2008 from late 2007 to the crash. The bottom of the market was March 6, 2009, 56% dip in the S&P 500 index, which is obviously absolutely terrible. That's the biggest dip over... I think that's actually the biggest dip ever for a year span. So... But here, look at this, though, is that I think that we were supposed to have a recession like last year, around February of last year, but then it just didn't happen, and the market's been on fire again for the past year. It is making me a little bit nervous here how much the market has gained over the past year, over even the past 5 years or so. It's making me a little bit nervous here, reminding me of the mid to late 90s, as I've been saying for a while here. So is a bigger crash coming? Maybe. It might be bigger than 2008. I don't know. Hopefully the mortgage, there's no subprime mortgage crisis like there was in 2008. Hopefully that's been tightened up. Maybe it's going to be in consumer debt. Maybe it's going to be in auto debt. Maybe it's going to be in other forms of debt. Who really knows where this bubble would be? Maybe it's in the stock market itself. Maybe it's in funds. Maybe it's in, who knows where it is. But it is making me nervous here. So is a bigger one coming? At the end of the day, some people say yes, some people say no. I don't know if we're going to have that one-day drop-off like we saw in 1987. That's, I guess, the moral of this video here. Is I don't know if we're going to have a 22% drop-off in one day. When the end of this economic cycle hits, it might be a slow, maybe over a few weeks, few months, something similar to 2008, where it's one bad day and then they just kind of keep getting bad for about a year. That's what I expect to see, not the big 22% drop-off in one day in the market. But again, I could be wrong. Who really knows? Now, I want to actually just keep going on this article here just for a second here, because they go on to some stuff about millennials, okay? And this made a really good point here. So a lot of you, almost all of you listening to this are millennials. Under the age of 35, above the age of 18. The vast majority of you listening to this or watching this are in that age category here. And I saw a really kind of good point here. So there's the subtitle here saying millennials are holding back. Pretty much meaning that there's an irrational tendency showing that people fear losses more than they look forward to gains. And so that prevents a lot of young people especially from investing. And so it says here that over half of adult Americans, over half of, I think it's adult Americans or millennials, 54% don't own any stocks or investments, period. They don't even own real estate. They don't own anything that's an investment. And so I'm guessing there's maybe even 60 to 65 to 70% of millennials don't even own stocks or anything like that. All right, so that's including, Roth IRAs, and that's including 401ks. You're not invested in the market at all. So if you're just invested in the market, period, for the long term, you're ahead of 50% of people in your age category, which for investing purposes, for your financial health, all that. You're ahead of half of people your age, which is quite astounding. I mean, I've been investing since I was 18 years old. I've been tracking the market since I was about 14 with my old BlackBerry. In ninth grade in high school, I'd sit at the back of the class, and instead of paying attention to English and Hamlet, because who really cares about that stuff? Who really cares about Hamlet at the end of the day? I'd just be sitting back there. I remember tracking this gold stock specifically. I was like, man, this thing's going to pop off. I forget what gold company it was, but it was something. It was essentially, it wasn't a penny stock, but it wasn't like an established blue chip company. It was one of those stocks that was in between. And I was like, oh, I would have invested in it, and it actually doubled. It doubled in value. It went from like $4 to $8 or something in the span of 48 hours because apparently they bought up some land, and underneath it was just a bunch of gold or something like that. It was some really weird story like that. I remember I was sitting at the back of class when I found that out. It's like, oh my God, I should really get into investing. Maybe I should talk to my dad about this. But I waited until I was 18 before I started trading. But anyways, that was a little bit of a tangent. Me trading on my BlackBerry when I was 14. Just amazing, because I talk to people my age too. They have no idea what the stock market is. People that I've been hanging out with since high school that are my friends, they have no idea what's going on in the markets. Zero. Unless a big crash happens, they don't understand anything. So this is why it's so important. This is why I like you guys listening and watching stuff like this. Why it's important. If you're listening and watching this, you're putting in information into your head. So whether it's articles, whether it's my own opinions, whether it's opinions of other people that I talk about, I mean, it's really good that you're doing this and you're staying up to date and you're gaining knowledge about the markets, because at the end of the day, just by investing, period, and it's not in penny stocks, if you have just an average investment plan and you're investing, you're ahead of 50% of people already, it's quite amazing. So, yeah, that's why it's important to listen to podcasts and videos like this. Stay up to date, keep learning, and so on. So anyways, we're going to move on to the next thing I want to talk about is actually Blue Apron, because I got to keep you guys updated on this. So Blue Apron, they've had a rough 6 months. So since their IPO in the spring of this year, remember their IPO, they were supposed to IPO at $15 per share, and then like a few days after they made that announcement, before the IPO, though, they have to announce what they expect, and then the IPO happens about a week after. Amazon announced that they are going to get into the food delivery service, similar to Blue Apron. So the IPO, instead of being $15 per share, it ended up being about $10 to $11 per share. And then it kept on dropping and dropping and dropping and dropping. And currently the stock price of Blue Apron is $5.30. $5. That is, so if you bought Blue Apron if you were to have bought Blue Apron, by theoretically, before Amazon announced the Whole Foods thing, which you couldn't have done, but you would have lost about 70% of your money on this investment if you were to sell right now. And so today, Blue Apron has announced that they are cutting down about 6% of its workforce. So they currently have 5,400 employees. So cutting down 6%, that's about, doing the math there, that's about 260, I would guess, around 250, 260 employees are being laid off. And these are largely people that are in the headquarters and in the warehouses, where they actually make the packets of food. And it's just what a company has to do. Actually says it's cutting about 320 jobs. Damn it, my math was off. Hate when that happens. Now I look like a fool. I said 260 instead of 320. I also said 250, but I'll shut up about that. You didn't hear anything. Okay, yeah, so Blue Apron, what do I think of Blue Apron? As I think I said this months ago, like, I'm interested to see. I haven't really been paying attention to to market over the past 2 months. I've been coding way too much, but I was interested because I still think that they're going to be a fine company. In the long term, they might get killed off by Amazon, sure, but I thought that in the short term, they might actually be fine and have decent earnings, but maybe that is just not the case here. The stock price has dipped that much over the past few months. I'm guessing that they haven't had good earnings. So that's unfortunate, but hey, I mean, at the end of the day, do you know why companies IPO? Here's a really interesting thing for a lot of people that don't really know about IPO. So why do companies IPO? Why do they go public? Okay, why would a company go public? It's a way for them. Well, there's a few pros, obviously. So some of the pros are, you get public attention. You get to be on the NASDAQ. You get it's this publicity, branding, all that kind of stuff goes with being a public company. But one of the big reasons too is so that you can raise money, and that you don't have to raise it from private investors that sometimes want to meddle in your business. You get to go public. You get to go public, and you get to raise several $100 million in one day, which is something that is really, really tough to do, especially if you go with the private sector. I mean, a lot of the times you're going to have to meet with some sort of venture guy, and then you're going to have to meet with them again in a week, and it's like, oh, okay, let's negotiate terms for a week, and then maybe you get a deal in a month, maybe you don't. And it's a lot of a big time commitment there too, and maybe they back out, maybe they want a seat on the board of directors, maybe they want their own position at the company. There's a lot of stipulations that come with going the private route. Now, saying that, private money in a lot of cases is better, actually, especially early on. But yeah, why people go public is so that you can raise several $100 million in one day. And you can also reward your private investors that invested in you early on. That's another thing too. I won't talk about that. So the fact that the stock price goes down over the course of 6 months, it doesn't affect the main purpose of the IPO in the first place, if that makes sense. Hopefully that makes sense to all you guys out there. Yeah, so just because the stock price has been cut in half since it IPO'd, at the end of the day, it's still IPO'd at a good price, and that's all the founders and the people that wanted to raise the money, that's what they care about. Now, obviously, they do care about the stock price because it means the value of the company. How much debt you can take out is also based on the value of your company, and a lot of other stuff too. That's a whole separate video. I'm not going to get into that. Let's move on to the next thing I want to talk about, which is Walmart. So Walmart looks to set its own online mall with Lord & Taylor. This isn't really massive news. I just had to talk about it for 2 minutes today, or less than that, because look, what this pretty much means is that Walmart is going to be partnering with another retail company, I guess, and they're going to allow more brands to be sold through their site. Now, here's something interesting that why Amazon has the advantage over companies like Walmart is because Walmart, if you were to go on their site, they only sell Walmart brands. So they only sell products that are sold, that they have made deals with and essentially sell through their site or sell through their stores, okay? And so they don't allow, average Joe Schmo to sell on their site. They don't allow people like you and me to sell on the Walmart site. Amazon, on the other hand, the vast majority of the products they sell on their site are actually not Amazon products, and not products that are partnered with Amazon. They're people like me and you selling stuff on Amazon, and people don't really realize that. Now it's shifting a little bit here, because now it's a little bit tougher to sell stuff on Amazon. They're kind of cracking down. They have a few big sellers. A lot of their people who started out like me and you just selling $1,000 of stuff a month, all of a sudden they've built up a business over the course of 3-4 years, and they're selling millions of dollars of product a month. They're becoming really big, and they're taking up a lot of the market share. That's a whole different story. But Walmart is, so they're going to try and include other brands. So they're going to try to do a different route than Walmart. Or sorry, different route than Amazon. Similar route to Amazon. God damn it, third try. That's the good way to go. Third try, I got it. So they're going to be incorporating non-Walmart brands into their site, potentially, is what this was. So next story I want to talk about. Alphabet, which is Google. Alphabet's capital G leads Lyft's $1 billion funding round. Yes, that is right. Lyft raised another $1 billion. And man, I believe that the company's going to be valued at, it says right here, actually. I was going to guess about $20 billion. But Lyft said the latest round boosts its valuation to $11 billion. Which is really, really good. It's still, a tenth the size of Uber or a fifth the size of Uber in terms of valuation, but that's still really, really, really good. But this also means that they sold off 10% of the company in this round to Google. So Google owns 10% of Lyft. They're just doing quick math, are about 8%, 8 to 9% of Lyft. So that's really interesting too. And I'm really glad that they're expanding. I'm glad that we got this competition here. Maybe Lyft surpasses Uber. That's still going to be really cool. The underdog story of Lyft. becoming the main driving. What do you call those apps? The sharing. The sharing market? The share market? What do you call those kinds of apps? Oh man, I just heard it today. I forget. It's wherever you use something you own to make money. It's like Airbnb. I know a lot of you are probably yelling through the podcast or through YouTube right now. Like, it's this. Oh, the sharing economy. That's it. That's what it is. The sharing economy. Got it, Jack. Good job. Yeah. Anyways, I'll keep track on Lyft, and it's really funny because these are pretty big companies. Lyft valued at 11 billion. Uber's probably 50, maybe more, 60 or 70 billion. Neither of them are public. Anyone notice that? Neither of them are public, that's quite astounding as well. That also makes me think, like, if I build up a company, do I want to go public? Now, here's the reason to not go public. Is because when you go public, Elon Musk says it's the worst thing, like in terms of what happens afterwards, is because now all of a sudden, anytime you want to make a big decision at the company, anytime you want to, you can't reveal a lot of information about the company in interviews. You cannot just talk about your company however you want. You usually have to build up a board of directors. A lot of the times your investors. Actually, another thing too is that if we are a public company, you're legally required to make these giant financial reports every quarter and every year, the annual reports too. You're legally required to do that and to essentially hire someone full-time or several people full-time to make these giant reports. And everyone knows all of the information about your company. Everyone knows where all your competitors know, where every dollar of your company goes. It's also a moral thing too. Like what Elon Musk said was that if your stock price goes down 5% in one day, what you're seeing is that the value of your company might go down several $100 million or $1 billion, and that has even though that doesn't mean anything in the long term or even short term, it has the psychological effect on you. Like, oh my God, these people don't believe in the company. These people don't believe in the company. The valuation's gone down. Maybe we're not going to be able to raise money. Is the company going to go in the crapper? Who really knows? That's what Elon Musk thinks of the stock market. And being a public company is that it can be tough looking at those numbers, so he tries to stay away from them now of the daily changes in the stock market for his company. So anyways, let's move on to the next thing here, retirement. I just want to ask you guys some questions here. What do you guys think about retirement? I haven't asked you guys this in a while. What do you guys think of Social Security? Now, this article says here Social Security is going to be fine for all young people out there. A lot of people are saying it's going to collapse. This article says it's going to be fine. I think it's going to obviously be somewhere in between. But do you guys rely on that, on Social Security, on that? How much do you get per year after Social Security? Is it 12? I thought it was like between $10,000 and $20,000 a year after you're a certain age. I don't know what the exact number is here. But yeah, what do you guys think about that? Are you going to rely on that? Here's another thing too. How are you going to plan on retirement? Like, what's going to be your strategy? Are you going to just save a bunch of cash? Or are you going to put it in an IRA? Are you going to put it in a 401k? Are you going to put it in, like what most people do, put it in your primary house? Are you going to put it in the stock market? Like, what's your plan? Seriously, I'm really curious as to what you guys think. What do you guys want to do for your retirement? Now, I plan on investing and building up companies and having passive income. I mean, what I like to think about is actually something I thought about recently, was that my passive income for stuff I haven't really worked on in 2 or 3 months has been several $1,000s a month of passive income, of stuff that I have put zero work into for the past few months, that is more than the average 75-year-old gets from their savings or their Social Security or their retirement fund. And so my passive income right now is more than Social Security, which is, I mean, that's really, really strange to think about. But that's also, it proves to you guys why you guys need to invest, why you guys need to, build up passive income streams too. You need to get out there. You need to start doing that stuff so that, I mean, seriously, one of the reasons why I'm able to code this website is because I built up that passive income. I'm able to pay off all my bills and still save up money, even though I'm putting no work or any sort of time or effort into my passive income stuff, and I'm still getting paid every month, thousands and thousands of dollars. And That's something that you guys need to do. Do you guys want that? I mean, that gives me it gave me the opportunity to pursue something that I wanted to pursue. And that's what passive income did for me. So it's going to, for a lot of people, they want passive income for their retirement. I want it so that I can pursue my passion in my early 20s. That's what I want to do. All right, let's move on to the next thing. Oh man, this video, I always think that these videos are going to be like 10 or 15 minutes. And they just haven't been that this week at all. So I want to mention this Jeff Bezos thing. So Amazon building WindFarms, they built, what, 35 of these things, somewhere around there. And why am I talking about this? Why does it matter? Well, first of all, they're actually pretty cool. They can supply, what, 1 million megawatt hours, which is enough for a small town. Can supply the energy for a town, essentially, these wind farms here. But what I want to show you guys here is, if you're watching in video, is this is... Jeff Bezos is now 2 for 2 in making the most badass entrepreneur videos on social media. So, Jeff Bezos here, he cracks, for those of you listening podcast form, he just cracked a wine bottle to christen it on top of a 300-foot tall windmill. And a drone is just backing up from his face and giving you this big giant camera shot. And it's just, man, he is 2 for 2 on these social media videos. That is so, so cool. Jeff Bezos on top of this giant wind farm. I mean, amazing. I'll show you guys the other one too, which I want to talk about, which was this one here, which is his first big awesome social media video was a drone coming in and giving a close-up on top of his giant rocket factory. And on top of his giant rocket factory, Jeff Bezos is sitting in a long chair with a sign that says "Rocket Factory coming soon." Pretty badass. He is 2 for 2 on these videos, and Elon Musk obviously does really cool ones too, but these are like badass, I'm awesome, I just built some cool companies kind of stuff here. Elon Musk usually shows some awesome videos of rockets and all that, which I love. It's just these two are like, I'm kind of badass videos. I like it. Anyways, let's talk about, oh yeah, just touch up. I talked yesterday about Amazon's headquarters. Where should they go? And this article just jumped on the exact same points that I talked about. Which was, again, the big positive. Yeah, it's going to bring in a lot of jobs. The big negatives, which took me a little bit to think about, but I mentioned yesterday, was, okay, if 50,000 tech jobs come in to the city, then what's going to happen to all the people who aren't tech, who are baristas, who are 27 years old and want to buy a house? Well, guess what? All the housing prices are probably going to double in the next 2 or 3 years, and they're going to be priced out of the market. Cost of living goes up. They only get, maybe the cost of living goes up 25% or 20% over the next 5 years, but your pay only goes up 10%. And all of a sudden, you go from, you know, slightly above paycheck to paycheck to having to move out of the city because you can't pay your bills. That's the downside they talked about here. Plus, housing prices are going up too. I talked about that, but anyways, that was just touch up on yesterday's topic. Last thing I want to talk about was this tech IPO. MongoDB. Okay, if you don't know what MongoDB is, this was something which I was going to build my e-commerce marketplace with. However, I had, you know, I don't even know if I should explain what MongoDB is. So what MongoDB is when you are building a website on whatever, any website that stores data, you have a few parts to your website. You have your front end, which is essentially, you know, your front end is what the user sees. So it's like HTML and CSS. So all these, like, you know, at the top of the page, this says Market Watch here, and all this title and all this text. This is all front end stuff. All these pictures, it's all front end, okay? All the layout is front end. On the back end, you have the server side code, which is, you know, a lot of people use PHP, a lot of people use Python. There's a lot of back-end languages, and that's essentially on a server, and no person sees that code except for the person actually writing it. And then behind that is the database, okay? And so there's 3 parts to any website. There's the front end, there's the back end, and then there's the database. Now, the database is part of the back end. But if you don't know, Oracle, one of the biggest companies in the world, worth several $100 billion. Larry Ellison, the owner of Oracle, is the 5th richest man in the world. He pretty much owns the databases for all websites. Almost all websites are, like the majority of them, use a database that is Oracle's. I use one that is Oracle's. Okay, so what Oracle's databases are like is they're very plain, they're very structured, but they're very efficient. There's a lot of support for them. It's really easy to use them. And they've been around a long time and they've worked really well. What MongoDB is they are a completely different database. They are not structured, but they can store a lot more information. And if you know what you're doing, it can be a lot more efficient. It's just there's not a lot of support. Not a lot of people know how to use it compared to typical Oracle databases. And so I was actually going to use MongoDB, but because I was such a noob at coding and wanted to build the site as fast as possible, I didn't use that, and I used the one with more support, which was Oracle databases. But anyways, that's the backstory of MongoDB. So MongoDB is this new database company that is trying to compete with companies like Oracle. And I was surprised because I didn't even know that they were IPOing, and I know what this company is, and I just didn't know that they were going to IPO, which is, I mean, I've been paying attention to business this week. I just didn't know. They IPO'd today, by the way. Today. Okay? And so today, actually, the shares were up like 30% or something earlier today, which is crazy. But so they IPO'd today. Shares reached a high of $34, cooling down a bit. They last traded at 25%, up 25%. That's right. So they're currently up about, let's see, they're up probably about 28% since their IPO, excuse me. And well, I just wanted to talk about this because this is a $1 billion company that just went public. They're currently valued at $1.5 billion, and they're competing with a company like Oracle. Oh, also Amazon. They're also competing with Amazon because Amazon is also is a giant out there now. So Oracle doesn't own all the databases anymore because Amazon took a lot of market share, Amazon Web Services. And so now all of a sudden MongoDB is competing with Amazon and Oracle, and they're actually doing an okay job. Here's my unbiased opinion of this, okay? My unbiased opinion is if you know how to use the product MongoDB, I think that personally is a better product than anything that Amazon and anything that that Oracle has to offer. Okay, because I've used all three of these, by the way. I've tried using Mongo. I did try using it for about a week. I did try using Amazon's for about a week, and then I stuck with Oracle because that's the easiest one to use. And MongoDB, what I like about it is has the largest customization. This isn't, I know I'm just talking this up. I swear they're not a sponsor or anything. I'm not even using them. But they have a lot of customization, okay? So you get to customize a lot of the information that goes in and out and how it interacts with all this stuff on your website. With Amazon, it's really strange because they have a dynamic pricing, and so there's a lot of fine print, and there's not a lot of, it's a lot more confusing. Amazon's databases are very, very confusing to use. They do not have clear instructions. They do not tell you how to set anything up in a clear way. And it's very difficult to install the databases for your site. It's just all in all, it was difficult. So actually I do like Amazon's the least out of all of these here, but and Oracle's was just super easy to use, and it was the best one. So hopefully, I don't know. That's just my opinion on these three databases. MongoDB has the best product, followed by Oracle and then Amazon, but Amazon's gaining ground on both of these because Amazon's the giant, regardless of how good their product is. Now, actually, no, I shouldn't say that, because here's the difference between Amazon and the rest of them is that Amazon has a selection of databases. I know you guys are probably rolling your eyes right now. Like, more talk about databases. Amazon has like 40 different database packages. MongoDB has like 4. And Oracle has like hundreds, but they're all essentially the same thing. Amazon has databases ranging from, if you just want to pay $1 a month to run your site, and have grandma and grandpa visit it, and that's your only visitors, to being able to handle, giant sites like Netflix. I think Netflix actually uses Amazon Web Services, that's their competition, which is quite strange. So anyways, I think, that's going to wrap this video up here. I talked a little bit too much about that stuff. Sorry if you're all rolling your eyes right now, but I thought that I'd educate you. I don't know. You guys are doing this for education too and learning about tech, so I tried to explain that in English as much as possible. Anyways, I'd like to thank you very much for watching. You can check out my stock market program if you want to set up your account and learn how to invest and all that stuff. And you can check out the Wealth Accelerator if you want to check that out as well. It pretty much teaches you what it takes to run a business and getting your mind right, and talking about what essentially it takes to run a business and start one. So anyways, I'd like to thank you very much for watching. You're all very beautiful people, and I'll see you guys in the next video.